Now, today we are going to talk about momentum-based indicators. Now, in the past, we have covered the fundamental analysis. Now we want to talk about a bit more on chartings, how you can analyze the charts, so that when you learn these skills, you'll be able to time your exit and time your entry, and you'll be able to understand what the chart is telling you about the state of the stock right now. So now, as usual, disclaimer, this webinar is only for educational purpose only. In no way that Bursa Malaysia or us Live Chain recommends any stocks to you. And when you do this, when you go through this webinar and you decide to make any buy or sell, you do it at your own financial risk. Is that okay? Now, we have a series of webinars installed for you, from the first session to the 12th session for this year, and we are now at the 5th session of Momentum-Based Indicators Masterclass. So every month we have one session, so make sure that you stay with us throughout the next webinars for the next webinars for every month. So today I want to introduce our speaker. So it gives us great honor to have invited CC Yong, who is a full-time trader. Now, he has many years of experience in trading the market. He is also a local participant of Bursa Malaysia Derivative. So if you have any questions in stocks, he also traded stocks for many years, traded derivative for many years, so he can answer all. So he's founder of Straits Index, a proprietary trading company and associate participant of BMD. He's a trader, trainer, and writer. He's also a speaker for SIDC, CPE courses, and also various financial institutions. Not only that, he's also a columnist for Sinchu Daily, Money Compass for more than 10 years. So he's somebody with many years of experience, whether in teaching you how to see the chart, or whether in trading the stocks as well. So he's someone with really in-depth experience in trading. So without further ado, CC, I'm making you the presenter now. Over to you.
Hi, Chen Shang, and good evening to everyone. So, okay, let me show my slide. Okay.
Excellent. We are seeing your slide now.
So today agenda there's three. First is basic of the technical indicators, and second we'll cover the momentum-based indicators, and then we will go through how to use these indicators into your trading strategy. Okay, let's start our seminar here. Okay, but the third part, the number 3 will be the most important part, so I'll spend some time there. Let's discuss what's technical indicators. I copied this from the Investopedia, so you can refer to this. An indicator is actually just mathematical calculations based on prices, volume and open interest sometimes, of securities or a contract. So by analyzing this historical data, you can actually analyze and use this indicator to predict or forecast the future price movement. This is actually from Investopedia. So let's move on to the next slide. To me, principles of this technical analysis is actually to provide a systematical representation of the market directions with statistics. This is usually how I look at indicators. So I almost like never look at indicator as is something that you can predict the futures, because in trading I believe that the market is actually almost unpredictable, but of course you can prepare for it. So because, as I said here, experienced traders actually knows the futures is almost unpredictable, but you can always prepare for it. So what are the principles of this technical analysis? It is actually we actually have 3 main principles of this TA, and the first one is market price discounts everything. That means anything that happens in the market, whether there are storm coming, whether there is a new policies coming to the country or company, and so on and so forth, it's all presented in the price. So that's why we say the market price discounts everything. That means everything will affect or going to affect or affecting the prices of a stock or contracts is already factored in the price. So if the price is high, there's a reason for it. So I often hear that investors or traders or basic traders say that, oh, the price is so high, so probably will come down, or the price is actually low, so probably it's reached its bottom already. Usually I recommend not to do that, because the price is high actually for a reason. It could be a reason that unknown, or nobody can predict it correctly. So it doesn't matter what affect the price, but so long as the price is there, high or low, so it's there for a reason. And you or we may or may not know the reason why, but it stays for a reason, and all the reason should be factored in the prices. It could be unreasonable high price, but yeah, it's unreasonable can be that reason already. Second, price move in trends. This is what we look for. Let's say if the price go up, it should continue to go up until it reach resistance or some other factor that changed the trend. So price should move in a trend. Otherwise, if price doesn't move, so we can't actually trade, because trading, we need the price to fluctuate up or down. So there's a downtrend and uptrend. But of course, when you look at stocks alone, you can only buy low and then sell high later to make money, to prosper. But also nowadays, there's a lot of call warrants and also put warrants, which you can trade the market in a different way. For example, if CI is going up, okay, so the put price may actually come down. But if the CI or the index is actually coming down, the put warrant will go up. So there is some instrument available for you in terms of trading the market, but not only traditionally you can only buy a stock, but basic idea is you still buy low and sell high. Whether you sell high first or buy low, but the way you make money trading is still buy low, sell high, or sell high, buy lower. And third principle of technical analysis important is history repeats itself. It means that whatever you see in the past, it should actually, when the condition is actually repeating itself, it should actually repeat itself. So that's why where you can actually spot the patterns and trade these kind of patterns. So by saying this means doing records, okay, preparing yourself to trade the market is actually important, because everything it could actually happens before, but if you haven't noticed this kind of pattern, you may be caught actually napping. So that will actually may or may not cause you to lose money. So you have to prepare yourself before start trading. Now, for example, this is one of the chart showing that, okay, the principle one, remember, okay, the line is actually a 200-day moving average. The arrow showing you that the price of this is a CPO contract, our star contract from Bursa Malaysia is the CPO, but you can use any example. It's an index, be it a commodity. So if the price drop below 200-day MA, so usually in technical term, it's actually a sell signal. Okay, and then you see the second time it hit that resistance again. Okay, it becomes resistance. The MA, if the price cannot break above the MA, price should continue to come down. But of course, during this period of time, actually there is some incident. For example, in this case, because of stock is actually abundant, that means whatever affect the fundamental of these stocks or this contract or this commodity or securities is factored in the price. If you adjust the indicator correctly, you should able to see that if the price is below 200-day, so usually the trend will be a downtrend. And vice versa, when the price is actually above 200-day, it should be a bull run or actually an uptrend. So we can look at another example. In this case, for example, this is a pattern called head and shoulders. Okay, you can see that the price swing up, down, but it is a pattern recognizable. If you check correctly, you can check that this pattern has been repeating in, for example, Dow Jones for like the past 100 years. Every time you see this pattern, usually there will be a downtrend followed by this. Of course, there's various conditions have to be met before it really happens. But okay, if you can spot this kind of trend, can you trade? That is totally different idea. Sometimes you can spot the trend correctly or spot the pattern correctly, but you may or may not actually make money from this kind of analysis. I'll discuss more about this later on. Okay, another thing that you have to take into consideration is what type of indicators you want to use. For example, most common indicators is like moving averages, which the average price of a contract or stocks, and another one is actually Fibonacci retracements. This is actually popular, but we can't go into detail of all indicators, but I will actually probably share with you how to actually interpret indicators in a different form. Okay, another one is actually Bollinger Band. I like Bollinger Band. I think I started technical analysis like 20 years ago. The first indicator I liked was Bollinger Bands, but Bollinger Band is actually very popular in Malaysia nowadays. And the next one is actually stochastics and RSI. And the last one, but not least, then you can see that most common one probably is MACD, which you actually derive from two moving averages, and then apply another moving averages, you get an MACD. We discuss about MACD in a bit also, but when you trade, all I want to share with you is that there are some things that you have to be careful. Is all the indicators has a traps, okay? And I've seen some traders, they start with technical analysis. Honestly, I start with technical analysis, and then I do a lot of testing and trading with the indicators, okay? And I have seen so many traders start in this indicators trap. That means they start in the indicator and they can't actually pull themselves up because of these few elements. First will be collinear effects. What is collinear effects? Collinear effects is something that, let's say, if someone tell you, if one indicator is good to trade, why not we use 10? We combine all this 10, and all this signal, if give, let's say, if 50% of the, or more than 50% of the indicator telling me to buy, so I should buy. And if more than 50% tell me to sell, so I sell. Can this make a very good trading signal? The answer is actually no, because most indicator actually gives you almost similar signal almost at the same time. So if you actually try to look for too many indicators, you will be in a forever loop of learning how to trade. Rather than you actually going to learn how to trade, you'll be actually chasing many indicators. You want to learn A, B, C up to Z. And after Z, then A, B, A, C. You'll be forever learning indicators, but you must actually accept that you don't need to know all the indicators. If your friends tell me this indicator is better, it's actually totally okay if you don't follow, because you can actually master a few indicators is actually more than enough for you to start trading because of the collinear effects, okay? Second will be confirmation bias. What is actually confirmation bias? We will actually fall into confirmation bias is because, let's say, for example, you look at certain indicator. Every time this indicator give you this signal, you say, okay, this is very good indicator because every time it gives me this positive signal, the stock will go up, and it should be actually used. But do you know that somehow rather you actually fall into your own confirmation bias? Is that you are actually looking for this signal, and you actually asking yourself to find this kind of signal. For example, most people would say that we should actually become an entrepreneur, open a company, become boss, because most of the boss are driving Mercedes-Benz, right? Then, doing business is actually the way to be rich. But actually it's wrong, because you look at all the good example, but do you know that probably 90% of the business owner actually fail in 5 years times? You don't know, right? Because you have never find this kind of example. You open up the magazine, you always find a good example of entrepreneurship and all this. So confirmation is bias is because you are trying to look for indicator to buy. That's why you always find that indicator or indications that you're looking for. So that is the second trap that please remind yourself, avoid this kind of action. But how to avoid? Because our brain actually will perceive, always try to find, let's say for example, I sit in the computer, I want to find what indicator is best to use. So you browse from one to another one. So to find this kind of signals, then eventually you confirm, okay, this indicator at this condition, I should actually buy or sell stock, right? You have to remind yourself, don't over rely on this, but I have ways to probably show to you how to get out of this kind of confirmation bias later on in our presentation. Thirdly is over optimize. What is over optimize? Okay, if you use an indicator of, let's say, moving average, 10-day moving average, it shows you some buy signal and sell signal, but you want to optimize it whether 10 days is actually better or 9 days is better, or maybe 8.5 days will be better. If you're trying to do that, you actually try to over optimize a certain indicator. So actually, if 10 days is okay, 9 days or 11 days is actually no different. Okay, in long run, it shouldn't give me a major difference in terms of profit and loss. So you get what I mean? Is that do not try to fine tune an indicator until so fine, which you over optimize. Because once you over optimize, you will fall into the last trap, which I want to present to you, is curve fitting. Curve fitting is a situation that, let's say, if this indicator has been working for the past 10 years and give you a probably every year 10% return, all right, so should be good, right? But that is actually we call curve fitting. Curve fitting is that you're trying to fit into the past. I mean, you try to fit the futures in the past. That means if the past is the wave is actually 3 wave up, then 4 wave down. So you'll be predicting that the next trend, the next 10 years will be same pattern as well. So if you do that, or if you have this in your mind set, probably you especially when you start trying this kind of trading, and you find yourself you make some money out of these kind of indicators, then you'll be believe yourself 100% or 110% into it, and you try to trade this, but up to a point you find that all this don't work anymore, because you actually have fallen into all this trap is collinear effects, confirmation bias, and over optimize and curve fitting. And it's hard to explain to you this, how important to identify this before you really go into full-time trading. We'll talk about this in the later part of this presentation. I have a note, usually I call a trader's note in my seminar. So it's that it's always some point that is important in trading is you have to believe that you don't have to be a good analyst to make money. Okay, you have to set your objective to trading or invest in stocks. Okay, you want to make money or you want to be a good analyst. But I want to tell you or share with you is that you don't have to be a very good analyst to make money. A good analyst, maybe you know that what is coming, what is BOJ doing, what is Federal Reserve is doing, what is Bank of EU Bank is actually setting up the new policy. You based on these kind of things, you analyze and then you forecast or predict the next trend, or you based on Fibonacci retracement or wave theory or Dow theories, you know that where the peak or where is the bottom of the next trend. But do you have to be perfect on this? No, actually, because you don't have to be correct every time to be a trader. So that's why you have to use the indicator carefully. If you're just starting to do learn technical analysis, it's good to take up this point is everything is actually double whammy. It gives you some edges, but also take you away something away from you. Okay, I started technical analysis like 20 years ago. That time there's no YouTube. It's very difficult. I have to, read a lot of books. I even had to write my own software to test a lot of ideas. But nowadays you can learn technical analysis just going through YouTube. Okay, so let me share with you something that you may not find in YouTube is that technical indicator alone actually may only contribute 10 to 30% of winning trade in real life trading. All right. So sometimes one person need to be only focused on trend because indicator mostly you look for trend, but sometimes you don't have to be. But talking about a trend, then we have to discuss probably about momentum-based indicators, or sometimes it's trend indicators. Is the center of all technical analysis, which you look for something that it begins from $1 and go up to $9, so that you make that $8. So momentum indicators actually measures the price relative to previous close, or moving average. You compare to something so that you know that it's away from the original price in certain speed and volume. Then you can actually say it's a trend. So hence it's a momentum and a trend indicator. And most momentum-based indicators are actually created like an oscillator, which we will actually discuss more in our next webinar later in August. And price relative momentum often is actually measured against, usually MA, moving averages, and usually we use price, to know the trend following strategy for the trend strategy. So if you further enhance this tool, you actually get two indicators or two MA and form an MACD. So MACD is actually moving averages, convergence and divergence indicator. So we will actually use this indicator to build a system later on. Okay, so MA is average price of n period, so that you calculate how many total up all the prices and divided by how many days. It usually reflects the mass movement of market participants, and shorter period for shorter time frame and longer for the longer time frame. This is a formulas, probably you don't really have to do it, because nowadays you can get all these averages prices calculated, just a blink of your mouse click, and all this you can get this already. So let me show you an example. This is a core trading signals by moving average, which we have shown this example before, which let's say composite index, if the index drop below, in this case 200-day MA, so 200-day MA almost is like 1 year average price. If the index falls below 200-day or 1 year average price, usually we consider this as the market is going to be heading south, so you should actually take an action on selling. Okay, and the opposite is actually you take long when the price is actually above 1 year average. So we take another example is actually if you further enhance MA is actually a simple MA. We call exponential moving average. So why I introduce this? Because usually I build strategy based on either EMA and all this trend or momentum indicator. So EMA is actually a weighted moving average. Okay, it's actually a type of infinite impulse responses filters that applies weighting for factors which decreases exponentially. So the weighting for each older data is actually decreased exponentially, and it's never reached zero, so it's always smoothened. Basically, it's actually smoothened and actually apply some weightage. So this slide is the formula of how to calculate this. Again, you don't have to know this, but in a nutshell, EMA puts more weightage, okay, on the recent price movement, and it creates exponential smoothened moving average. So that's why we call this exponential MA. It has got less noise and all this spike and sudden movement. So let me show it to you. There's one example over here. Is using 31 simple average. Okay, you can see that the price actually break below the MA or SMA. Okay, before it's actually rebounded. So if you use a break or crossover signal, you will actually see that the price drop below MA and you sell. But after 2 days or 3 days, the price actually recover and rebounded and go even higher. And then if you feel like cut and turn, okay, then the price actually drop below this again, and you sell, immediately it will rebound on the second arrow, right? So this we call, because SMA has got this kind of disadvantage. Just so in order to overcome this, you see, I switched to EMA. So EMA has got a better smoothened curve, which you can see the price was supported by this EMA rather than breach below or cross over the indicator. So that's how you can actually slightly improve your trading if you use a correct indicator. But now the next $1 million question, it will be, okay, how to get this kind of period or parameters? Should I use 31 or 41 or 22 or 10? So one of the way is you go through, the stock one by one, whether you print or you use computer software, you can subscribe to all this software nowadays. You can go through the stock one by one, and then you change the parameters to see the best result. But of course, now if you have 1,000 stocks, then you will have problem how you want to find the correct period. Okay. The second way is actually better, which you use a computer backtest system. We'll discuss in the next topic on this, how to look for a trading signal by using computer backtest system. So for this, actually, we try to use a software, but before that, I pick one indicator. It's easier, it's straightforward, so that we can we go through this indicator and then we use this indicator to build a system, whether this system will give you a positive expectation from your trading. So MACD is the indicator that we choose, okay, and some history was developed. But in this case, we will use 12-day EMA and 26-day EMA. So that's why MACD is actually not an SMA, but it's an EMA, okay? And the trigger line is also an EMA. So actually it applies 3 layers of EMA in this case. It's very smooth. It's actually designed for trend. It has got less spike and all these noises lah. So it's actually used as a trend following momentum indicator for the mid to long term wise. So, okay, what are the trading signal? The trading signal can be simple as this. We look at all these arrows. Whenever the EMA, the short EMA cross down, is actually a sell signal. Okay, so whenever there's a small cross, it's indicated the price can go lower lah. So that's why from here you can see how this indicator actually giving you a sell signal. And on the next slide, there's another signal we use to actually measure the difference of these two lines, the trigger lines and the MACD lines. So the distance of this is actually from a so-called oscillator. So you can see that if a round bottom means the price can actually reverse and go up, and vice versa. So all these are round bottoms. Okay, this gives you slightly shorter period of the triggers actually shorter period of time frames lah. So another opposite is actually a round bottom or round top. Okay, it will give you a sell signal instead. Okay, just now it's a buy signal, now it's a sell signal. So this will actually give you some indications on how to actually you can so-called create a system that give you buy or a sell indicator. So from here, we will look into one example. Is besides this, there's also another type of signal. One MACD actually gives you quite a number of trading signal. Another indicators or indications in is when the MACD lines drop below 0. Okay, it's actually considered a long-term sell signal, or long-term trend will be moving lower or down. Okay, so whenever the MACD actually drop below, you can look at this area here. If drop below 0, okay, going to negative, it means the price can actually go lower see after this. Okay, the next one is, okay, the opposite, which the price actually go higher and break the zero from negative to positive. This will actually give you a buy signal instead. All right, so you have a sell there and you have a buy here. So both combined, you get, you know, a trading signal, you know, short and long. But of course, if you look at this system, if you follow all this correctly, you actually don't make a big money because you didn't sell at high and you don't buy at low. To me, I'm quite against, you know, how to actually capture the high and low, because if you ask me how do I know the market reach bottom or, you know, reach a high, actually you can wild guess once or twice, you may get the correct answer, but in long run, guessing where is the high and the lowest point of certain prices is actually most difficult thing to do. Imagine that if you can guess where is the high or low of certain security stocks, you actually can make tons of money, you know, because you know the effective where is the starting point, the price going to go up, you know. So okay, let's move to the next topic. Okay, here probably is one of our most important topic is, you know, how to build these indicators into a trading strategy. Well, the reason I focus more time on the trading strategy because, you know, I have less time for you for the indicator. There's so many indicators for you to choose. You can just pick one. Okay, I don't mind. You can choose any indicator you prefer, be it EMA, be it MACD, stochastic, which we discussed. Okay, in earlier, you know, there are 4 or 5 indicators I just shared with you. You don't have to go through fancy. You don't need a proprietary indicator which created by someone and said use this because no one uses it. So when you use it, it is best. Over these many years, I've been using just all these indicators that I just shared with you. I don't have my own indicator. I never develop an indicator, and I only use a few indicators in my trading. Do not combine all indicators into one chart, because if you do that, you will have like 10 or 20 lines in a chart. Then you become over optimized and curve fitting into any trading signal. So once you're curve fitting, you may be making money for the first, you know, or second or 2-3 trades, but at the end, in long run, you may not actually make money out of it. Okay, trading strategy, you need to have a strategy, not only trading signal. Sometimes some base traders, maybe they try to find a trading signal but not a trading strategy. So my experience tells me that all you need actually is trading strategy rather than trading indicator. Okay, but a trading strategy can be built with indicator, right? And there are some strategies built with just, you know, price and volume as well. You can actually, the price itself is actually an indicator, because price, you can form a candlestick, you can form a Heiken-Aishi, you know, which it itself is actually an indicator. So we will discuss about building a strategy with indicator in the following slide. Okay, so so to develop your strategy, you have to understand a few things lah. Sometimes more indicator does not mean it's better. In fact, quite the contrary, which the lesser the indicator in your strategy is better. Okay, so I might actually, you know, surprise you. If possible, lesser is better because you have lesser noises, lesser variable. So it's easier for you to test, or easier for you to come up with a good trading strategy, but not over excuse me, not over optimized. Now, you have to define some rules. Okay, what are the rules that you have to, you know, take, you know, but all these rules you must probably get this from your experience. You know, what you should not do. Should you actually use a margin to leverage? You know, how much leverage you can trade, and what is your maximum loss, risk management. These are rules that you have to set before you can actually trade. Okay, don't go in with, let's say, 10,000, then you buy a stock worth of 10,000 and you hope that the stock can make money in the next month. Okay, so this is actually not a strategy. This is no rules. All right. When you design a strategy, please bear in mind there is actually no perfect strategy. So you must set a reasonable expectation. Actually, all these 4 points are very important. Okay, if you set an unreasonable expectation, your trading journey will become very, very difficult. Let's say, for example, if you put in 10,000 and then you expect you will make 10,000 for the next month or every month, which is 100% in return, you will make yourself, your life will be miserable because it's so hard to achieve such kind of expectation. So you should actually put a very reasonable expectation. So reasonable, what is reasonable? 1% is reasonable. That means 10,000 you make 100 ringgit. So I'm sure some of you will be say unreasonable. Okay, but believe me, in long run this is reasonable. 1%, 2%, or 3%. If you put a very optimistic return, probably is 10%. Very, very optimistic. If you put something like 30, 40, 50%, I would say unreasonable, but you can try. But how long you can actually sustain the growth of your capital is actually another question. Now, let's move on to the next slides. Okay, the traps have been discussed something already on the traps, but these are another traps of strategy, which they are curve fitting. This is repeat. Indicator also we have curve fitting and confirmation bias again. And this time, let's we look for, when you build your strategy, beside these two, you have to look into, not to fall into these kind of traps. You have to be aware that if you do a manual testing, okay, it's actually, you will be subject to a lot of confirmation bias and curve fitting, and there's no forward testing. What are forward testing? Forward testing usually is we talk about in the old days. Forward testing is we actually do a paper test, okay? But do you want to develop a strategy that 10 years data and then you want to test another 5 years to make sure that it's not curve fitting? So you do a forward test. Now, this forward test, if you do a paper test, that means you have to trade 5 years on paper, then only to know that whether your strategy works or not. After 5 years, you'll find that your strategy don't work, then you spend another 5 years to test another strategy. No, you're going to spend a lot of time or too much time on that. So that's why in this kind of thing, the computerized testing actually come into play, which you use a computer system to actually back test your strategy. This will help you not only the speed of the computer, it takes the confirmation bias away from you. That means you don't rely on your own judgment anymore. You define the rules, the computer will test based on your rules and give you the result. So without you, subjectively you say, this signal I take, that signal I don't want to take. So you give a very good result in your strategy, which you try to lie to yourself, right? So computer testing, you will avoid yourself to fall into these kind of traps. So you don't no longer do this, and because you cannot lie to yourself, so whatever the result will be statistically represent the system or strategy in a very objective way. That means it's actually something like certified, whether it works for the past 10 years or not. It's only back test anyway. So in the market, I think there's some softwares that are available for you to backtest if you're trading, some other platforms. But if you trade Malaysian stocks, you have choice of, let's say, for example, using all the software to test. But I introduce you one of the software is actually freely available to download. Okay, it's called Ninja Trader. The software is actually quite easy compared to many platforms. So you download this software. Okay, today I'm going to show you without doing any coding, no computer coding, just use your mouse or point and click, you can create a strategy. In this case, you create a new strategy, okay, use your mouse, you click, create new strategy, right? Then you click next, okay. You create some inputs for your strategy. In this case, we will use EMA 1, EMA 2, okay, which two MA to cross over and look for trading signals. Okay, no, sorry, this is a MACD strategy, so we will use the EMA 1, 2, which to define the MACD parameters. Okay, so in this case, 12 days default, okay, 26 day default for EMA 2, and then your target percent, that means how much percent in terms of profit to take profit. Okay, you see in my trading, I have my profit target and I also have my cut loss target. Okay, that means I don't believe that I can make money forever. Okay, so I need to set the limit of when should I take profit, and a strategy without profit target is actually a bad strategy lah. And then your trading percent, that means if the price go up, let's say 50% and come back, what is the percentage it dropped from the peak to higher before you stop yourself out. Okay, and your stop loss percentage, that means when you go in, how much money you're going to lose. And the last one is actually the MACD smooth, which is usually is a 9 EMA factor in this case. All right, with this we select the indicator. In this case, we are actually doing an MACD strategy, which is I think I find it very easy to do this way. You can follow this method, you know, and try yourself. You can do it tonight already actually. Okay, you select your EMA 1 and 2 as the parameters for fast and slow EMA for the MACD parameters. Okay, once you select the indicator, and then you choose a trigger. What is a trigger? Trigger is when to enter long. In this case, say long is it's just a typical terms for buy or long. It's actually effectively a same name. So enter long, okay, or buy signal. In this case, I put buy as my strategy name, okay. And these triggers will be, that means whenever MACD actually, in this case, break the variable, okay, then it will actually enter into a buy signal, okay. And then I set some condition for the stop loss, for the profit target, and also trading stop. In this case, you just add and then choose the menu. There's no coding, no programming at all in this strategy. That means you just point and click, point and click. Okay, before that, I also want to mention to you, there's another variable here is to sell, okay. First one is buy, then second one is sell. There's a sell which in the set 2, which is just a repeat of this signal but in reverse, okay. Okay, from there you can have choice to actually view your code or you compile your strategy. So once you compile your strategy, you can actually also can go back and change your strategy parameters just to fine tune. But also at the same time, you can actually look at the codes. If you're good in programming language, you can actually go into the code and manually edit or fine tune. So the coding part is where all the miracle happens, where you can actually fine tune the strategy up to, you know, certain strategy you want, the risk management, the money management part, you know, the automatic stuff is all in the coding. But in our case, we just want to backtest whether a simple MACD strategy, whether can it be a good strategy. So that's why trading, you never take the trading just for granted. If you want to trade certain signals or certain strategy, make sure that you actually can backtest and prove to yourself and you trust it yourself whether this indicator works or not, right? In this case, after we backtest, we realize that it gives you a positive expectancy. Okay, positive expectancy is another crucial point where your trading results should always give you, there's no perfect strategy which you may actually end up lose money. In this case, you can see that you actually gross profit is actually 5 ringgit and 70 cents, and your gross loss is actually 2 ringgit and 70 cents. That means your net profit is only 3 ringgit compared to, you know, your actual maximum profit is 570, because you will lose 270 also in this case, okay. So but over the long period of time, it's still a money making strategy. It's not perfect yet, but it's actually a good strategy enough already if you just follow a very simple strategy. And this computer software will give you all these kind of statistics, okay, even up to when to buy, when to sell, or the best thing is actually, as a chartist, you like to see where is the actual entry points and where is the actual exit points. You can see that your buy signal here is actually after excuse me, after like 2 weeks, the market rebounded, only you enter into a trade. And also when the price actually reached the peak, about 2 weeks later, then only you exit the price, and your selling price may not be a best part, because after you sold, the market can actually go up, but at least you can buy here, okay, and then you can sell later here, which means you actually make a small trend and into your profit. Okay, so that's how a strategy can works, in trading, and you can simulate this and come up with the result. You know that MACD works. Okay, you don't need a miracle proprietary indicator to trade, but in this case it works already. Now let's move on to the next slide. Okay, if you have this kind of code or strategy, okay, this strategy without codes, okay, you have this strategy created, and then you can actually apply into various stocks, okay, to prove that this is strategy not only work for one stock, but it works for many stocks. In this case, I actually included a few stocks, so that overall not all the counters actually make money over for the period of time, but if you combine all, the result is actually quite impressive, and it gives you a positive result only with a very simple strategy. Now, question is, how come a simple strategy, maybe some of you used it before, but you don't get the expected result? And that is actually another part that you have to be look into, is okay, your money or risk management system. Any strategy don't work like 100%, okay, if you only have a trading signal, because center of all successful trading is actually on the money and risk management. If you don't have these controls, it is very hard to make money in long run. And sorry to tell you that most traders will fail at this part. So for me, I actually want to stress, if you want to break through, you maybe have been trading for some time, but probably you need to have breakthrough because you want to be a consistent trader that can make money. So these are the part probably you have to look at next, is risk management. So how to define, how to manage the risk. Managing the risk is difficult part. It's not easy, but even you know how to do it, you tend not to do it. The reason is because most trader will tend to take bigger risks to make more money rather than take a smaller risk to make a consistent return. For me, I'm actually working as a full-time to trade as a full-time. I mean trading for a living. So what is most important for me is consistently every month I can make some money so that I can pay myself as a salary, okay, as income. So if I can't be a consistent trader, so I'll be actually in trouble because my business is actually trading. So this is actually the trading center of all the trading, but it's simple. I think last year I did one webinar on risk management. You can go through Bursa webinar, but we don't have to go through all this. The summary of this risk management is using the 1% risk. Okay, what is 1% risk? Is that means if you have 100,000 in your equity account, and 1% risk means you never want to lose more than 1% of your equity. That means if 100,000, you don't lose more than 1,000 in every single trade. Okay, and most important at all is you cut loss when you lose more 1% or more than 1% of your account in that particular trade, or you hedge your position. But hedging is not the part that we talk about this now. Actually, most of the trades I trade is actually, if I lose money, I hedge, so that I try to minimize on losing or cutting losses. So sometimes people tease on me and say that CC Young never cut loss, but it's actually the way I manage the losing position. In this example, I'll show you how to actually, you know, do this risk management in, one of the example is, let's say for example, if you have 1,000 in your account, okay, if you buy a stock price at 1 ringgit, for example, with 100,000 of cash means you go in this particular stock in all in, that means you are investing in this stock because your total returns rely on this stock, the management, the ROI, the counter dividend, the stocks dividend yield, and the earning per share will affecting all your return if you go in with all your money into one stock. Okay, but since you're investing in a company, so you're trading, no, this what I don't call it trading anymore because this is become an investment. But if you want to actually trading stocks, okay, you should actually able to do it in a different manner. For example, if you actually set the maximum loss you're willing to take, which I just mentioned to you, 1% means 1% from 100,000 will be 1,000 ringgit. So this will be your cut loss point. So that's why just now when we define the strategy, I actually define the stop loss at 1%, So because the strategy has got a stop loss point which I set at 1%. So that's why even some of you might be using, MACD for sometimes, but you may not come up with the same result. The reason is because I fix my stop loss at 1%. Okay, and the computer will run and execute the 1% for me. That means any loss more than 1%, it will cut loss, right? But when we are actually trading, okay, because you're not using computer to trade, you go in the price, okay, you trade, you make money, but once you lose money, you go in, immediately the stock fell 1% or 0.5%, you said, okay, wait for 1%. When it reached 1%, you said, wait, maybe it's rebound, and then 1.2% you lose, 1.5, 2%. What you do? You don't cut. You said, I will actually average down, or I will actually keep it for a while because this is a good stock. This stock has got giving a very good return in terms of ROI. So you're giving you excuses and sort so that you didn't cut this position. But in my case, I'm using the computer to do a back test 1%. Sometimes it cut at 3% because anything more than 1% it will be cut, right? So that's why the back test system will give you a positive result. But when you're actually trading, you might not get the same result if you're doing it yourself. So that is the difference of which way you're doing computer or by your own individual. So the next thing probably I want to remind you is that if you develop a strategy this way and it's positive, stick to the strategy. And I know it's very, very difficult because sometimes I find myself also, whether should I follow the rules, every day we will be facing this kind of situation where should I stick to it? Because if I stick to it, then I might cut loss, But believe me, at the end of the day, you need to execute to what the rules that you have defined, because these rules you actually able to survive in long run. Okay, and from using this 1% rules, you can calculate the position size of your trade. I mean, how much money you go in. Okay, you have to, in long run, you have to make sure that you don't go in, very big position at one go, because each trade, how much money you put in is actually how much money you put into risk in your trading. So try to use the smaller size possible in your trading. In this example, I'm actually usually use a calculation. You can do it in your Excel, for example. Let's say you put in 100,000. Usually I use Excel or use this software, and you put in your risk tolerance is, let's say for example, in this case 1%, and your stop loss is actually 10% of the stock. Let's say for example, if a stock that worth 1 ringgit, if it fell below, falling below 90 cents, then you should actually cut loss. So if the stock price is actually at 110, okay, So what is your position size? In this case, the software will tell you that you should actually buy 9,000 shares, okay, and your stop price will be 99 cents. So based on all these formulas, and your maximum loss is always 1,000. That means whenever you go in any stock price, you always lose. Try to lose not more than 1,000. But sometimes when you cut loss, the price is not there, so you may cut at more than 1%. But over in long run, if you follow this kind of strategy, you actually will be able to come up, make money like it's supposed to be. You know, you have a MACD. I just show you MACD works. I place a lot of stocks. I can keep on backtesting all the stocks. It works. You know, the whole basket of stocks. All right. The only problem is whether you can stick to your trading strategy that designed by yourself. But your worst enemy is not the market. Your worst enemy is yourself. Okay. So in summary, building a strategy may not be too complex. You know, it's actually quite simple. I just show it to you how simple you can come with your strategy, and you need a system that can give you a positive result over long term, which we call a positive expectancy. And one good trade or one good day or even a month does not count, because sometimes if you create yourself, you know, try to do a manual, you know, sometimes, oh, I go in this way, I make money. So can you make sure that every month you can make money using the same method that you just did? So once you have a good system, robust system, you practice it by following all the rules you have just defined, okay, using the system that you just created. And for stock, you have one additional advantage is you can actually combine the financial result and give you a much better trading returns. In this case, I'm actually combining with some P ratio, the price of book, the growth, the earning per share, to give a very simple result. In fact, most of the time, I'm just using a very simple mechanism. 20-day break new high. If the result from the financial or fundamental is good, so usually it gives me indication this is a good stock to start investing. So this is how I normally trade with the system that I have, and plus the fundamental information which you can find from Bursa Malaysia. You record down in your Excel, whatever way you want, then you can actually start trading and trading for a living, you know, hopefully in the future. So with that, actually, I conclude my webinar today. I'll probably pass back to the host, and probably we can take some questions from there.
Excellent, so much. Thank you, CC. So today we have come to the Q&A session. So if any question in regards to how to use indicators, especially momentum-based indicators, you can please write it here so that CC can answer and address your concern one by one. So I have first question on my screen is, can you share with us like what is one of your best strategies to use in trading?
Okay, my best strategy so far will be mostly are based on price. If you talk about strategy alone, I'm actually doing a hedging strategy. That means whenever I go in, especially in a substantial size, that means I'm not talking about going, let's say one lot, you know, one shares, you know. You go in a substantial size, usually I do a hedge position. That means I wouldn't just buy stocks. I'll buy stocks, sell futures. I will probably buy a stock, index stocks, okay, and then I sell FKY futures. Let's say, for example, before this coming elections, we can see that a lot of foreign funds actually bought our stocks, right? So, is that means that they know the market will go up? No, they do know the market will go up, but they know that the price was low that time. They went in because before the election announced, or just shortly after the election announced, they know the price has potential to go up. It's actually, in fact, they are the one who push up the price, right? Because they go in a big size. But what if the index or the stock that they bought decline, and they might lose money, right? They may or may not, because they can actually sell FKI. equivalent FKI. Let's say, for example, if you buy 100,000 stocks, you can sell one contract of FKI, which it neutralizes your short-term fluctuation. Let's say, for example, if you buy the stock come down, your futures short FKI make money. But if you buy a stock, okay, and the stock, let's say after this election or the next 6 months, the stock will actually improve in terms of 30% of the stock price, then you make 30%, right? Then you just stop your FKI contracts. You can enjoy that 30% gain in terms of stock price. Then you bought your shares this year, most likely at the bottom of whatever stock year you go in. So this kind of strategy, probably I call it the best strategy in trading from myself.
Okay, yeah, so here you right, this is a hedging strategy. Okay, so CC is not only a stock trader, he's a trader. Okay. So anyway, so the next question we have here is what is your MACD setting for intraday trading using a 15-minute chart?
Okay, as I just mentioned just now, do not try to over optimize your indicator. Okay, the indicator you should use for your 15 minutes should be also 12 and 26. Okay, same like your daily, same like any other time frame. You may actually adjust, but the reason I don't like to adjust the parameter of a common indicator is for a very simple reason. I do not want to over optimize my system. That means whenever you trade, you try to over optimize your system, then you become curve fitting. So a lot of system tester actually we like to not over not some of my friends that I know, they don't optimize their system at all. That means they just pick that standard parameters and they trade using that, and they use their own risk management to actually improve their trading without actually optimizing any parameter at all. If try not to, because the more you go into this optimization, you actually, as I just said, fall into the same trap again. So I would just recommend you to use the same parameters, 12, 26 enough already.
All right, so I also use the same parameter. I did not change my MACD parameter. Yeah, so the next question I have here is, can you elaborate the difference between principles and theory? Because I see your description of principle of technical analysis is the same with the Dawes theory.
I think I can't define a very black line between this. What I mean is actually the basic of how this technical analysis is actually about. So basically, if you talk about this is a theory or it's a theorem, it's the principles, I accept they are one of the same thing that we talk about.
Okay, yeah. Well, maybe I can help to address that as well. Now, from what I understand, the foundation and the principle of technical analysis is based on the Dawes theory. So that's why it is very similar, because it takes from the Dawes principles and theory.
Yeah.
Yeah. So the next question is, what do you think about stochastic versus the MACD? Like, which is better from your experience and back testing?
All right. Stochastics for me, I'll be using it for short-term trading. For MACD, I will use it for mid and long term. Both are very has got their own advantages. Okay. Basically, I will use stochastic. If you want to look at very small movement in a short time frame. But when we talk about indicator, beside these two indicators, you can pick one. Okay, don't use two in your strategy. Okay, otherwise you get into trouble if you use two indicators. two of these two indicators into your strategy. But you may add one indicator in your strategy, which I didn't mention today, is we call it VWAP, okay, volume weighted average in your, if you're doing intraday trading. So which will give you some reference of what is the average price of today, as of today lah. Okay, so we call it IVWAP, something like that.
Okay, yeah, forgot that I mute myself. That's why there's no sound from a bit. Yeah, so how about RSI? Do you recommend to use it? So there's another question.
Yes, I use RSI as well. But nowadays, what my main during my analysis will be, I'm using EMA and stochastic. Because I find that the RSI and the stochastics, to me, they're actually giving a very, very similar signal. So I pick one. So in my case, I choose stochastic over RSI. It's just a preference. You can use either one, because in my understanding, if you use them correctly, they should actually give you the very similar signal. Remember when I said collinear effect, so both indicators should give you a very similar signal if you use them, quite in a good manner.
Okay, yeah. I also use stochastic more than I use RSI, because I see that stochastic tend to give me more signals than RSI.
Yeah, good choice.
Anyway, just now you mentioned that there are so many indicators that you use, right? There's a question that asks like how many indicators that you use, and in what time you use which indicator.
Okay. Honestly, for stock trading, to me, I more rely on a daily basis chart, because I don't want to over commit myself into trading intraday basis. So I'm using mainly on the daily bar basis, okay. And then the indicator I'm using is EMA, which is EMA 10 and EMA 22, okay. And the other indicator for short terms is I'm using a stochastic, okay, a standard slow stochastic. One of the reason I use a slower terms of time frame for stock is because during daytime, actually, I'm trading futures from Bursa Malaysia, the CPO, the star contract as well. So that is actually more on my intraday basis. So I cannot overcommit myself to trading too many product at the same time. So that's why I choose this way. For my strategy on the stocks.
All right. So yeah. So the next question is, how can volume be used in conjunction with the technical analysis?
Okay, volume is quite a unique so-called indicator, which it gives you when is the biggest movement and what is the weightage on it. Use it wisely, especially you combine with, as I said, if you trade intradays, you should include one indicator called IVWAP or so on, because this will give you where is the price average at certain volume. So I'll be mostly based on the volume with the IVWAP indicator for intraday basis lah. But again, for trading stocks, besides that, why I'm using daily chart, because I just want to share with you is that probably about 40 or 50% weightage that certain stocks that I'm recommending is actually based on fundamental. The reason is because if one of the stock fundamentally not sound, even the stock patterns looks nice, my style, I never go in such stock. I usually require some criteria to be met before really call this good stock to start trading. So some are, let's say, basic one is whether the P is low or whether the earnings actually positive. There are some stocks that give very good technical indicator, but the underlying, asset, probably earning per share is actually not that sound. So usually I will filter out this kind of counters because for trading, we have limited capital. So I can't take all the signals that, from a bunch of stocks. If all the stock give me a signal, but I can afford to only trade maybe 5 to 10 stocks. So I can't take the 20 or 30 stocks. So I have to actually filter by using the fundamental. So this probably you have to take into account as well.
Okay, so another question is, does Ninja Trader support KLCS stocks?
All right, Ninja Trader itself, now they are a broker. They actually cater for some European or US stocks. Okay, so they don't support Malaysian stock by default, but you can purchase their data, or they allow you to import data from your Excel. So if you have a format in a text format, so usually a CSV format, which you can, let's say if you subscribe to some data service or Bursa Station, as let's say for example, they're able to export data into Ninja data, and you import it to it. That's how I do it actually.
Okay, so another question is, do you teach back testing course?
I think I did this a few years back, but nowadays I be more focused on another strategy, which as I just mentioned just now, the hedging, which we call spread trading, which we will have this webinar next week as well, using you can check on Bursa Marketplace as well on this webinar. But on the strategy part, I think Ninja Trader has got very, very good community forum, which in fact, I myself actually learned a lot from there. So yeah, you should be able to be not so difficult to find all this material you want, especially YouTube. They have a lot of information. How to use, how to backtest, how to program the Ninja Trader. But of course, to be really, really able to program Ninja Trader in coding, so you need some programming background lah. But I just show it to you. You don't need to be. Sometimes you just want to proof case. That means whether this indicator is actually usable in actual trading. So you want to backtest in a simple manner. By using mouse click alone, you can actually backtest the system that you wanted to. So I think I probably just introduce you to something that it's very important. It's enough for you to show that this indicator is actually useful already. But yeah, I'm not sure I'll be teaching this class in any near terms more at this moment.
Okay. Yeah, so the next question we have here is, what is the best time frame to use for short-term, mid-term, and long-term traders? Like, should we match all the time frame before open the position?
All right, there's I've seen some people trading 2 or 3 time frames. I've seen some of the presentation as well. Okay, my personal opinion, okay, when I trade, I do look at 1 or 2 time frame, but I don't really like combine these 2 time frame before I make my judgment. Let's say daily bar is a buy signal, then 5 minutes bar is a buy signal, then I go in. I usually don't combine this kind of thing. Okay, during my intraday basis, I only look at 5 minutes chart. I used to have like 5 minutes, 15 minutes, and 30 minutes, and yeah, try to combine all this. But honestly, after some period of time, you find yourself you don't need to be all optimized. You don't need a perfect signal. You don't need to have all this core linear effect combined to comfort you to have a fearless entry. Sometimes after you're trading for a while, you find yourself very fearful to go into certain trade or every single trade. This is actually another problem that you'll be facing. Not the technical, not the system, not indicators anymore. You'll be facing the challenge of fearful from your previous or past trade. So because of certain experience that you start to look for a very, very comfortable, confirm, 100% can go in, can make money, then only you trade. So that is the moment that you find yourself in fear. So in actually trading, we should go in without fear. But going without fear, I don't mean that you go in so gung ho, you just whack here, whack there. No, trading without emotion is a more appropriate term, which means whenever you look at the signal, you don't need to have so much confirmation. You go in as your plan allows you to, and you allow yourself to be wrong at certain point of time. So don't go for perfect signal, because you will never find a perfect signal. When you train yourself to look for a perfect timing to go in, you will end up, you find this opportunity but you didn't go in, then the price actually disappear. You know, it runs, okay, a trend. So the second time you see this, you will jump the gun. So this is a problem to avoid. How to avoid this is actually to go in, allow yourself to make some mistake. And in trading, you should be able to, you know, let's say out of 10 trades, 3 or 4 trades is actually losing money. It's actually okay. But of course, try to be as high as possible in terms of winning rate. But you don't need to be 100%. So my time frame will be, I'm using 5 minutes for intraday. Then for longer time frame, I'm using a daily bar. But my tricks for stocks is always I'm using so-called fundamental ratio, which is P ratio, the earning per share, and the price to book. These things, you know, can help me to pick correct stocks, and you know, and the technical analysis give me a correct timing. For future trading, I do something different. So I never go in one direction without hedging. So yeah, you need to combine this strategy so that you make your trading become stable. But time frame wise, 5 minutes is enough for intraday basis. Stick to one. To me, stick to one. Don't go for 5:30, then daily bar combine. You find yourself very, very difficult to be consistent, because you always need to look at 2-3 time frame to confirm this. And have you ever retesting? Let's say 5 minutes combined with 30 minutes and combined with daily, and out of this indicator, out of 10 years, and it works. So far I haven't find someone really like give me this answer whether combining the different time frame can give you a surefire way, you know, to trade. So yeah, sorry, a very long answer, but my short answer will be 5 minutes for intraday trading, okay, and then day mid-term to long-term using a daily bar enough. I don't even go for weekly anymore. So 5 minutes and daily bar, okay, is enough. But if certain stocks are very illiquid, okay, sometimes using 5 minutes or even using a daily bar is not so sufficient, because you will see a very weird pattern, right? If you find this kind of situation, let me show you, let me probably suggest you to change your indicator from candlestick or bar chart to Heiken IC. So if you use a Heiken IC, it gives you a slightly better view if the stock is actually low in terms of transaction or illiquid. So do actually check out Heiken IC chart pattern.
Maybe you can share more about Heiken Nashi. I think many of us may not know what is Heiken Nashi.
Yeah, I remember last year we did the Heiken IC on this, but yeah, Heiken IC probably if you compare to candlestick just show you open high low bar, but Heiken actually takes average of the prices of previous high low close and combine that into today's bar. So sometimes it gives you a better picture. Let's say for example, you may see a dot in daily bar for candlestick, but Heiken actually may show you 3 white bar, which is actually a buy signal, and vice versa. Sometimes you don't see anything in the candlestick, just a dash and some long shadow, but the Heiken actually may shows you it's a 3 black bar, which you should actually consider selling the stock. So Heiken actually will able to probably overcome certain stock that with very low transacted volume.
All right. So to know more about Heiken Nashi, just please go to Google Google it, then you have more idea how they can change the chart and become a nicer chart. They can give you more information. So the next question we have here is like, which trading software you are currently using for stock trading in Bursa?
Stock trading, I'm using a software actually by my company. It's called WinChart. Sorry, Chun Sen, they asked me. So by using this software, I actually at the last slide actually I did show it to you. The way I pick stock is very actually quite simple. Before I look at their indicator and all this, I look for a stock that break 20 bar new high. That means 20-day new high. Okay, so I will filter out all the stocks from Bursa Malaysia, all the active stocks. So once I filter out all the stocks, then I will go through one by one, check on their fundamental ratio, financial ratio, which their P ratio and the earning per share. So those stocks that without good earnings, I will filter out. So from there, probably every week I'll pick like 3 or 4, 5 stocks only. You can see all this stock selection in my publish it on Simchio and also our company Facebook. You can see that actually we're using just a very simple way, but over a long period of time, you can see that these kind of stocks are really the moving stocks in the market. But not every single stock really every stock are making no. But you know, in the whole basket for the whole long-term time frame, you can see that the stock actually performing well in the long. This kind of selection perform well in long term.
Okay, so is there any way that they can learn more about this WinChart?
Oh yeah, they can go to my company website, which is strixindex.com. Okay, which is my company name.com lah. So yeah, you should be able to find some information from there, you know, or you can contact my office. So there should be someone able to assist you on how to, you know, find out more about this product. Thanks.
All right. So the next question that we have here is, can you recommend the best free charting tools besides TradingView and investing.com?
Free one.
I would say maybe Access.
Yeah, chances is actually quite good, but I'm not sure. I think long term I never checked whether it's still there. Still there. Okay.
Yeah, still there. Yeah, Chances is still offering free software for you, but it's for up to 3 years data. If you want to have full historical year data, you need to purchase data from them.
Oh, okay. I think you can start.
That's for me lah.
I think
because I use Chances.
Oh, you can start using Chances. I tested and used Chances before. Good thing is that it's free. But because I've been used to write my own software and do it, but back testing, as I said, I use this Ninja Trader, but Team Viewer, what's the new name already? I think this now online one is actually quite robust. They have a lot of things, but I'm not really like trying out all this software. To be honest, I'm quite like stuck to what I'm doing. What I'm showing you in all my webinars is what I'm using every day. So yeah, probably Chun Sen can explain more on all the softwares.
Yeah. For me, I think I use more on Chances. So you can go to www.chances.com. Just go to download the free software, which will give you market data up to 3 years for the local stocks. So yeah, I think that should be enough for most of us. Okay, unless you're very professional, then you may need to have more historical year data, right? But of course, I myself has subscribed to their package where I can see up to 20 years data. So now, the next question is on like benchmark. Like, what is our target? So what should we set for the winning probability for as for a target?
Okay, winning rate. Okay, basically to trading for to make consistent money, you need to have at least 65%. If your winning rate is actually less than 65%, it's very difficult for you to make money. 65% means out of 10 trades, you have 6.5 trades actually make money. So try to write down and do your own statistics. What is your winning rate? So you have to find out your winning rate. So if you have 65%, then using the 1% risk should be okay. But if you want to take more risk, probably you need a higher winning rate. Let's say, for example, 75% or even higher. So you need this kind of, and then of course, over the long term, you need to have a very positive expectancy system. That means over the long term, you still make money. How to calculate the expectancy? You try to, or you can Google how to, get the calculation of the expectancy of your trading.
Okay. Let's do one last question before we close this session. Why do you keep hedging? Wouldn't that be reducing your profit? That's the question.
Wow, that's very sharp that you pointed out. Yes. When I hedge, my profit is limited. But why I hedge? The reason I hedge because I believe that the market is almost unpredictable. Although you know that, okay, let's say for example, you do a back test, you know that every year this stocks, this pattern, it will be a good, it will from A to B. Okay, you buy this stock. Often or not, the stock will go down, probably 1%, 2% before it go up, right? Then you go down 1%, 2%, you cut loss before it go up, right? So that is the reason why I almost like not really rely 100% on the direction of the market. So once I don't rely on 100% on my market, so how I going to trade? So I want to trade something that different. So something how different is that the difference of my trading is that I don't rely on trading the trend. I'm trading something different, which you can say I try to trade no trend. A lot of people will find that even trading anything also you're supposed to need trend, but no. In my kind of trading, I find it's easier if the market just sideways. The market just move 1 point down, 1 point up, 1 point up, 1 point down. So although it limits my profits, but it's also limits my risk. So as you know, I'm trading for a living, so that I need to have that consistency. Every month I can make some money to pay my bill, pay my installments. So I need consistency, so that I need to have a very low risk trading strategy, which I can almost like know how many percent I can salvage from my capital. This is what I'm looking for. So I want something that low risk but not high gain. Okay, I don't need 100% in my return every month. I probably need a few percent return from my trading. So from there, I need to have a strategy that can give me a positive expectancy every month. Even the trading as stocks, you need to have something similar, because in stocks sometimes the market can just probably just coming down for 1 month, 2 months. So trading for a living will be very difficult, because you can't make money for that 2 months. So what you do is you have those put warrants, you have the FKI, you have all these uh, trading mechanism or instrument for you to do a different strategy for trading as a full-time job.
All right, so that is it. 65% for the winning rate is the target that you should set if you want to become a full-time trader and a successful trader as well. So now we have come to almost the end of it. So let me take back the presenter control.